Okay, this is for our contractor and developer partners. Although Conductor is known for being an advisor on PPAs and on tax credit sell side advisory, we also place a lot of loans and have a lot of integrated financing discussions across all product types, from tax equity products like loans and leases to loan products. And so we have both good unsecured and PACE products. And over the course of my prior, 3 or 4 years at Y certainly placed dozens of PACE transactions. And so I wanted to share some good insight in how this conversation goes on the early stages. A lot of loan conversations start off as a discussion about interest rate. And I want to highlight some of the other parameters when comparing between these as a starting point for discussion. So above the line here, I highlight some of the similarities. With the institutional unsecured products now, and even some capital lease products in the market, and the PACE financing out there, certainly doing 20-year, plus or minus terms is widely available now. In all cases, for the tax credit, the customer owns the tax credit. I would highlight, as always, as an advertisement, we can work with commercial customers to sell the tax credit. Size is relatively comparable. You can certainly go very low, I would say, on unsecured, but with PACE, you can definitely get to some smaller loan sizes now. We'll talk about some of the challenges there later on, particularly with lender consent, a topic I'm very close to on the PACE side. And then underwriting, there was a perception that PACE did not require financials or detailed underwriting, but I want to highlight in all case, there's a DSCR focus and standard underwriting requirements. So areas where the two can differ: prepayment penalties, unsecured loans. We can do with low prepayment penalties. I would highlight, we'll talk about buy downs in a second. A rate buy down, is effectively a very high prepayment penalty in the early years. PACE definitely has prepayment penalties. Those will often start at 5% and can be structured to taper down. Geographic areas these products are available. Unsecured loans we can essentially do anywhere geographically, and we just placed a large one in Arkansas, and we'll be talking about that in the months to come. We're actually selling the tax credit on that one too, so it's a nice kind of 2-for-1 deal. It's about $3 million, so that'll be nice to talk about. PACE varies, widely available in California. I've certainly participated in some of the municipality onboarding and opt-in for PACE, but there are still limitations to where PACE is available. Lender consents, a big one that's not required in unsecured loans, but it definitely is required in a PACE context. And I can have discussions with you around that. There are bank considerations and ways to effectively approach that. Conversely, when it comes to interest rate, the unsecured products are going to be typically in the 8 to 9% range, plus fees. PACE is typically priced as a spread to treasury, so these days that may get you in the 7.5 to 8% range, again, plus customary initial fees on both of these, maybe slightly lower in a PACE context, but still being in the kind of 5% transaction cost range as a starting point. Milestones, you can do payment milestones under both. I would highlight that with PACE, you fund into escrow. So the good part about that is the funds are available and you have a sort of flexible time span for execution. The flip side to that is the customer carries the interest cost during that time. With unsecured loans, you typically pay interest on a draw by draw basis, but underwriting will typically be in the 12-month time frame, so it can trigger repricing and re-underwriting for projects that have longer completion and PTO timelines. And then finally, we have pretty broad. We can do solar roofing, energy storage, and electric vehicles with the unsecured product. PACE, you can do all of those, and more, often used for larger roof financings and other rehabs. So that's a good overview. When it comes to interest rates, I would highlight that you'll still see talk about buy downs. And having done many of those, again, I would highlight we see a loan come in where customer says, hey, I got offered 4.99% by another party. That is, in all cases in this environment, a product that comes with very high points. That in one environment, when rates were going up several years ago, may have been compelling. In a widely perceived declining rate environment, we fully expect that commercial customers are going to be refinancing their mortgages in the next 1, 2, 3 years. to lock in lower rates, and having those extra buy down points as principal out there that has to be repaid is effectively a large prepayment penalty. So we don't expect that the buy down options are that viable, but just be aware of that when you're hearing about 5% interest rates on long-term loans. That only happens in a high points scenario. So I hope that's helpful. Reach out to me if I can help you navigate this. We have a lot of conversations across this about this topic across multiple states. It's always welcome.